Welcome back. You're watching Big Deal, and Vikas and Sanjeev are here with us to tell us what's in store in 2017 for the deal street. So Vikas, tell us, which are the sectors which are looking most active? You said that IPO pipeline looks strong. So which sectors look most dominant in this particular space? Do you think that because of demonetization, because the way the banks have been performing, and the entire financial services sector is seeing a sea change because of the events that have happened in 2016, is that going to be a game changer for certain sectors and the themes are changing?
I don't think there will anything change. Significant change is happening because of demonetization from long-term perspective. So I guess in a couple of months' time or maybe a quarter's time, we should be back to normal from a demonetization standpoint of view. But if you see the sectors which are looking to raise capital or likely to be in limelight, I think primarily banking and financial services would be one sector which requires large part of the capital for growth purposes, and I think that would be the one significant sector which you will see will be raising capital both from public market as well as the private markets. Consumer is a segment which is always high in demand and less in supply, but deals do happen, and I think we have seen
at very high valuation. Is that going to really continue?
That will continue, because that is not going to change from a short-term perspective, because I think consumer has a long run ahead, and it's a beginning of a sort of long run. So I don't think it's going to have significant change because of one quarter's impact. We have had many quarters in the past for different reasons where numbers have got impacted. So I don't think that's going to have significant impact. So you will continue. I mean, we did Sheela Foam IPO, which did very well, which was just immediately after demonetization. So that speaks very well of this issue is not going to be very impactful. So consumer will continue to remain in limelight or in interest. I think sectors like infrastructure, within that logistics, transport, so infrastructure broad basket that needs capital, and there are certain segments where capital is available also, and certain segments I think you will see some sort of innovation happening for raising capital of the instruments that how do you get the new set of investors to so address that need of capital. So that's the one segment which needs large capital, will raise capital through various set of sort of new products, instruments, and you will see that also changing in this year.
All right, so a lot of fundraising also you're expecting. Yes. We'll come back to that with Sanjeev. Which are the sectors that and the pockets that you will be watching out for and will be concentrating on for M&A deals?
So in terms of sectors, I think we would continue to look at technology as one key sector. I think renewables continues to show significant traction. And we see that momentum being carried forward in 2017. Financial services has been very, very significant in 2016, and we see that continuing in 2017. And then we have the whole healthcare life sciences segment, which seem to be carrying a lot of deals into 2017. Apart from that, I would expect also consumer derivative, including logistics, to be a significant area from a private equity standpoint. And also, if you look at it, some of the early tech businesses, a lot of early investments going in things like artificial intelligence, machine learning, and others. So these 6-7 areas are where we expect private equity activity to be significant in 2017.
And what about strategic deals, Sanjeev?
Domestic consolidation, particularly in sectors like infrastructure, power, iron and steel, I think those sectors will continue to see significant consolidation. Also, I would expect to see a lot more consolidation happening in some of the non-stress sectors in 2017, because there's no point in being a small business, which you need business to have scale. And I think you would see a lot more domestic consolidation. I'm also quite positive about inbound investors into India, as long as the uncertainty, some of the local some of the factors which causing the local uncertainty goes away. I'm also quite upbeat about corporate inbound activity in 2017, and we are clearly seeing a lot more Western investors seeking to de-risk their investments, because some of them have greater exposure into emerging markets like China and others, and they want to de-risk and have investments in India as well.
So which are the areas that you are going to focus on? REITs and InvITs haven't taken off so far, though there has been fair bit of activity there.
In the assets which are good, decent, yield generating, you will see instruments like InvIT coming about, which is basically one side you have investors who are seeking yield, because I think in India interest rates are coming down, and if for a fixed income investors, getting 6-7% yield is a very, very difficult task at this point in time. So, you will see, and we are launching India's first InvIT next year, Sterlite transmission asset, and you will see it in that market. And, it is a AAA assets with a very assured cash flow over 30 years. And, can investor get access to that at 9-10% kind of yield, which is a great deal for investors, and for a long tenor.
2017 may see its first InvIT. I'm not too sure about REIT as of today. What about bonds? Of course, because in terms of the debt markets, in interest rate or the monetary policies, US and India are on a divergent path right now. We are going to see rate cuts and they are seeing rate hikes. How is this going to impact the overall ability to raise funds? Which are the instruments at play? How does it put bond market, which Edelweiss does a lot?
So, corporate bond market has been waiting to happen for many, years. And I think we have seen in last 1.5 years significant traction in that space. Lots of corporates who have a decent rating have started hitting the bond market through public issuances, and we have done many of them. Earlier it was considered to be domain of only public sector enterprises or very, very large corporates, but now we are seeing lots of NBFCs, lots of corporates coming and hitting accessing this market. So in some sense I think it's a very, very encouraging sign and good sign. Good corporates will disintermediate from banks to go directly to the bond market. It increases the yields of the investors and also reduces the cost of the corporates as compared to the bank borrowing.
Let's slip into a short breather, but we'll come back and talk more about the revenue generation of both PwC and Edelweiss from the deal street. Stay tuned.